What a trading week this was, and next week is going to be a busy one as well. My name is Blake Morrow with Forex Analytix, and you're listening to the Week Ahead video. Now, I have a surprise for you today. Ryan Littlestone, the co-host of the Flow Show, that's the free analytics show that we do in European hours, he's going to be delivering this week's Week Ahead video to you. So he's going to give you all the setups, go over everything that's going to be moving the market. So make sure you stick around for Ryan. He'll be here in just a few minutes. But I did want to say something before I let you go. This week is going to be the last week that we have our summer sale. So our summer sale, we've kept it on. For the last several weeks because we had traders that were coming back from holiday. They have all gotten back this week. So if you want to lock in 40% off your subscription price, and that grandfathers you in. That means when our prices go back up, you stay at the 40% discount. If you want to lock that in, you've got to do it this week. You've got to do it this weekend. You got to do it before Monday, because on Monday, we're going to close that off. And as we get all back into the volatility that we have going into the end of the year. So anyway, sit back, enjoy today's Week Ahead video with Ryan Littlestone, and I'll catch you next week.
Thanks for the intro, Blake, and welcome traders to the Week Ahead video for the week commencing the 22nd of September. Well, what a week that was. Well, 2 weeks, in fact, as we've been building up to all of this since pretty much the Labor Day holiday. So I'm going to just try and start by running over the important points from last week, why they're important for how we trade moving forward as well. And now, obviously, central banks were the main event and the main news, but and we had quite a few of them. So firstly, I'm going to kick off with the Bank of Canada. They started off with a 25 basis point cut. Their language was fairly neutral. They are now in a far more, let's say, reactive setting. That means, if the data does okay, they'll sit on their hands and only look to change rates if there's any material changes to the data. And that means either way for rates. So yes, the bias is probably still for maybe rates to come down further, but the bar will get continually higher for that if the data isn't too bad from here. The Norges Bank, they also cut by 25 points as was expected, although the data leading up may have seen them staying on hold. Now, as much as they noted that they expect a further cut for the rest of the year, perhaps, like the Bank of Canada, it seems they have also just raised that bar a little bit more for that possibility. Now, unsurprisingly, the Bank of England kept their rates on hold, and while the message was still about a gradual and cautious approach, Bailey did say that the timing of further cuts was more uncertain than before in August, which sounds a bit undovish on the margin. Now, since then, the market has taken it that way. We've pretty much wiped out all hopes of a cut this year, and we're not even pricing two by the end of next year, but more on that a bit later. Now, the Bank of Japan, they took a couple of steps closer to a hike with two dissenters at their Friday meeting wanting hikes. They also decided to start their, let's call it equity QT, though in an effort not to spook markets, they set a level for those ETF and riot sales, as Ueda said, that would take 100 years to complete at the pace they've currently set. Still, everything is ticking along as per their outlook, so a hike is still on the cards over maybe the next one, two, or three, even three meetings. Now, if they do get another round of positive real wage data like they saw last month, that may well be the trigger for them to go ahead and hike. So that's going to be an important piece of data we need to look at in the future. Right, and then we get all the way into the Fed. And back in the 1st of September, some of you guys are on Labor Day holiday. We were here working still in Europe. I said that the market is going to be coming back with a bang, and boy, did it. We had some wild moves over the Fed, and it's probably been the biggest meeting of the year so far. But I'll try and keep the details brief because I'm sure you're all up to speed with it. Firstly, we obviously got the 25 basis point cut, as was expected. No 50s in there at all. Trump's man, Miran, was surprisingly the only dissenter for a 50 basis point cut. Now, there were other suspects there too, Waller and Bowman, who potentially might have been other dissenters, but they stuck to a 25 basis point cut. So bit of a surprise there. Then we had the dots. Now the last dots had two cuts. This was before this cut, had two cuts for the rest of the year, and that was obviously their June summaries. The new dots had two more cuts after this one. So they've moved from two cuts previously to three cuts for the rest of this year. Now, that was really the dovish signal, but that's about all we got on the dovish front after that. The dots then showed one cut next year. That was in line with those prior June cuts, but the market was probably broadly looking for maybe two more cuts, possibly three cuts, depending on what the dot signaled for the rest of this year. So we only got, or only expecting, the Fed are expecting one more cut next year. Again, that's not dovish at all. Then we looked deeper into the forecasts. We saw better GDP numbers, better GDP forecasts, 2026 and 2027. And then we get higher inflation forecasts for the same period. Two things again. If you're a central bank cutting, looking at potential economic weakness, you don't go raising your forecasts for growth and inflation. And then the surprise was the Fed telling us that they basically had this cut because they're worried about the labour market. They kept their 2025 unemployment rate unchanged and lowered their unemployment forecasts for 26 and 27. Is that a jobs market that a central bank is worried about when you're lowering the unemployment rate, thinking things are going to get better? So again, none of this was dovish, apart from that extra cut tacked on potentially for this year. What did we see? We saw the dollar really running lower, pretty much on that extra dovish cut, or that extra cut for this year. But that's as far as it went. And really, when the market got stuck into the details, those forecasts, the initial sell-off completely reversed, and that has continued into the end part of the week and has still been going. So really, where does that leave us? Well, we had a market going into the Fed pretty much very, very dovish, and then we didn't get anything dovish. So naturally, we've seen those doves and dollar shorts getting pretty squeezed in this recent rally. What happens now is that we'll probably settle into some sort of a consolidation phase, because the bulk of trading has been about what the Fed was going to signal for the rest of this year and next year, because the market is already trading the future, always trading the future. So we've had that. We know where the Fed are, at least until December, in terms of their forecasts, but the market has a fair idea of what they're looking at going forward into 2026. So we've had the big volatility, and now we're likely to see things settle down, as I say, into a phase where maybe we just trade around the central bank rate expectations, and any small changes, we get to those. We're probably only going to see any wild moves if we get some big variations to what's expected in the data to come. Now, the next NFP is obviously going to be big too, as the market wants to see if we really are in a weakening trend, and how much worse that might get. So we'll still have volatility. We're definitely not going to go back to being as quiet as it was in the summer. Now, as much as it pains me to do this, I'm going to look at the Dixie because it tells the cleanest story of what happened in the dollar, and I know a lot of you guys and girls love it. So we had the initial blip over the FOMC, that big sell-off in the dollar. And then it's come roaring back since. As you can see, we busted through where we were. We've gone to fresh highs for the week, and coming in nearly enough into the month. So what I'm looking at now is this going to be sustained? Are we going to see this dollar rally continuing to move up? Is the market going to completely flip to something else? Now, looking at the economy itself, the jobs market may be weakening, but will it roll over? The economy is still holding up. So can it continue to do that, or will it roll too? Can it even improve? Can it maintain the decent growth that we're seeing there? Same as the labour market might. We really are at the moment now getting into a bit of a flux over which way things go. And as I'm not a trader who guesses, I can only be guided by whatever the future data tells me. And that goes for the rest of the market. So have we seen a bottom in the dollar? Let's go on to a wider picture and just give a clearer picture of that. This to me doesn't look potentially like we are yet at the end of a trend. We've had this downward trend in the dollar all year. The only saving grace I would say here is that we had a prior bottom, 96.39. We did nip through that over the Fed, but we quickly got back above that. So in one aspect, yes, we could have seen a bottom for the dollar. How long that lasts, though, is another question. And that's, as I say, we're going to be moving on to the rest of the data, the new data to come. And that will really be the decider as to whether this dollar is going to start really attacking this trend that we've seen so far this year, or is this just a bit of a dead cat bounce, the data turn worse again, and then we're going to see the dollar falling backwards again. So dollar in general, probably, as I say, going into next week, probably in a bit of a flux, a bit of what happens next mode, and we will take our cues from the data. Now, before I get stuck into the rest of the charts and what's coming up next week, I'm going to pass the baton over to Nick Groves for an update from Trading Analytix. So I'll see you on the other side.
Hello everybody, my name is Nick Groves for Trading Analytics. Ryan, thank you for bringing me on today. What an eventful week with the Fed. Let's go ahead and recap a little bit about what we were seeing out of the Fed on Wednesday. This is a report from Goldman. One of the things that I wanted to highlight is, yes, it does seem like more cuts are coming, but I thought it was interesting. The post-meeting statement noted that downside risks to employment have risen even as inflation has moved up. So it kind of puts us in a weird predicament where, okay, we might have more rate cuts, but are we about to have stagflation? And we've been talking quite a bit about that in the community. I was looking at trying to short gold. Let's go ahead and take a look at that really quick. I was thinking about shorting gold back in April because I had noticed that it ran up 30%. And if you go back and look at the last time gold went up 30%, it was 2009. So when we were up 30% back around this time, I was sitting there thinking, okay, well, there should be some mean reversion. But when you think about when it does better than 30%, you actually have to go back to the late 70s, 80s, when gold was having back-to-back 60% years. In those time periods when that occurred was during stagflation. So just keep that in the back of your mind. I'm sure Ryan and Blake will be covering some gold, but let's go and talk about equities. So take a look at the S&P here. Unfortunately, it's still on this channel. There's not a whole lot to say other than it's been extremely bullish. And, tech stocks, we're going to show those in a moment, have also been doing quite well. It has gotten past the 127% extension, so the next stop might actually be 7,000. I know that sounds insane, but I am willing to bet that we might actually find a correction going into October. One of the statistics that I brought for you all today is to take a look here at how the market actually performs when it's had a good summer. So we had at least a 5% gain over the summer, and what you'll see is that the win ratio in September is 14-10. But when you get into October, it definitely highlights that there's significant risk of downside pressure. So could that come from some type of data in the NFP and CPI going into October? I think it's definitely possible. And one of the things that has really screamed out at me is RSI. Take a look at Google on the weekly RSI. This is not common. Okay, the last time that we saw a week like this, just look at how strong Google has been. Just in the last 3 weeks, it's up 20%. You'll note that the RSI hasn't been this stretched since 2021. Now, really stretched RSI typically indicates that this should continue. But I do want to point out just how stretched this is. Looking at the daily, I can't even find a read. It goes back to 2017. So I do think that there is a risk of a pullback. Taking a look at Microsoft really quick, it had that euphoric run that we wanted to see after earnings. It popped up 10% and closed red on the day. Now it's stalling near the 38.2. I find that significant. And another one that I've been looking at this week is Intel. Intel screamed higher, up 20% or so the other day after NVIDIA agreed to buy shares of it pending regulatory approval. But I did want to point out to you all that this has actually come up to the 38.2. And the last thing that I'm going to point out, or second to last, is the semiconductors. I wanted to point out that the SMH VanEck Semiconductor ETF has actually reached the 127% extension. You're going to want to see AI pull back if this is going to pull back. The mags themselves, relentless, slightly above this throwover. It was starting to look like a potential evening star the other day, but is back above there, but hovering near the 127% extension. Maybe that will offer some resistance. But let's go and talk a little bit about crypto. So like I said with gold, Bitcoin, crypto tends to lag gold. So what I would love to see is a pullback in Ethereum. What's interesting about these coins is that, yeah, they're crypto. They're sometimes treated like, like a hard asset like gold, but there's actually a business model behind some of these. Ethereum and its blockchain technology, really interesting stuff. But if it is going to be treated like a commodity, I would love to be long this. And where would I like to be long? Right here around 39.20. You guys might have seen me talking about Ethereum back in April when I was buying it. Well, I made nice gains on that, but chickened out, and now it's all the way up here. So what I would like to see is a pullback to the 38.2, which also coincides with this trend line here. It would be a back test of the breakout, a back test that I would love to buy. If you're looking for more analysis like this, give us a follow at Trading Analytix, and I'm going to go ahead and pass it on back over to Ryan. Hope everyone has a great weekend. Cheers.
Thanks as always for that, Nick. Right, I'm going to get back to the charts. I'm going to look at a few of the key moves that we saw last week. Firstly, going to look at cable. And this one was pretty interesting, more so for how it finished, looking much weaker than the euro. Now, what was interesting about this was that the quid took a bit of a dump after two pieces of data on Friday. Firstly, we had another month of good retail sales in August as the good weather held out over here in the UK. And by the way, I'm expecting that to flip when we get September numbers because the weather hasn't been as great. We're back from the summer. I think we're going to see a little bit of a flip in that retail sales data. But what wasn't good alongside that retail data was a big jump in public borrowing numbers, which is going to do nothing but pile pressure onto the Chancellor and her budget that's coming up in November. And that really was the data that helped do the damage to the pound on Friday. Now, there's two things to note about cable. Firstly, if we look at the 2025 trend as a whole, we had a very, very solid bounce off the 38.2 fib here at 131.44. Now, that was a very, very bullish move. When you come down, hit a 38.2 fib of a big trend and it bounces, that's probably as bullish as it gets. Now, as far as I know, and if I'm not mistaken, and with the exception of a couple of pairs like Kiwi and dollar yen, this has been the only major to have pulled back to the 38.2 this year. So that's pretty significant that there's not many that have done so. And we'll look at the euro later and you can see that not even close. I haven't even got the fib on the chart yet because we keep making new highs. But so a pretty significant move there. But following that bounce off that 38.2, we failed to then go and take out that prior high. Last week, we came close to it, but not quite close enough. So that, on the other side, makes it look a bit more bearish. Now, when we see further gains in the dollar compared to some of the others, it could mean that this one is perhaps running out of steam. Now, another significant move here is that I've got a big level at 36.70. Now, this is a level we've tried to get above, quite a few times. And, we haven't really managed to do it, as you can see on the chart there, going back to 2021, 2022, the last time that we were above that level and perhaps holding quite significantly. 2021, 2022, This year, we've had little moves, we've had moves up to that level, but we can't get above and hold above that level. So that is also key here in the shorter term, following this bounce from that 38.2, that we can't get above and hold that level. So from here, I think maybe cable could be a bit more vulnerable to further gains in the dollar compared to some of the others. I think that this 134 area in the middle is going to be very, very key for what comes next. If we get a dip and hold to there, that will again look like a very bullish signal, and it will give it a chance for another run to the highs. Now, break below that 134s, we're probably going to be looking at the fib again, and that's all the way down at 131s. So this is something I'm looking at for the pound, and again, I'll explain in a bit later. A bit of weakness coming into the latter part of the year that may be aided if this dollar strength continues. Now, gold was another asset that we thought we might have seen some fireworks over the FOMC, and while we did see a move, we pretty much looking like we're going to close in the week, or we closed the week. Still looking bullish, but maybe in a bit of stasis. Now, my view of gold is pretty simple from here. We either go and take out the 3,700 highs and take them out properly, or we see a steeper pullback. Understand, though, that we are currently trading in a very, short-term set of price moves. After the big break from 3440s, 3500, we have seen that, absolutely rocket. But that came off a big consolidation period and a pretty big break of that as well when it happened. So we're not even close to that sort of magnitude now in terms of how we might break. So you need to trade it as such. So for me, if we're not looking at breaking 3,700, if we can't break 3,700, we're probably going to track down to 37, 27, 28. So look for whether this short-term range develops or moves perhaps to a wider spectrum. Maybe we move to 37.20, it becomes a top. Maybe we move down to 3,600 and it becomes a bit more of a bottom. So you're really looking to see what levels are going to come into play, what levels are going to develop, and maybe we develop something like what we saw when we had the break of 3,400, 3,500, where we had this summer consolidation period. But as you can see, that's much bigger than what we're dealing with at the moment. So pretty much we want to see how the market's going to work this one out. So if you are looking for something like longs, then you can do a small trade against whatever support levels you want, or you can try a break through the top. But you don't need to give it a lot of room. You don't need to risk a lot on these shorter term levels. Maybe if we were back trading a similar pattern to what we had 3440, 3500, bigger ranges, you can give it a bit more room to roam. But recognize that the price action we've got at the moment is very short term, it's very small. We're pinging $20 here, $20 there, and that's about the range. And that's how you've got to treat this one when trading it. Now, the last pair I want to look at just as a review is dollar yen, as that's been on a proper roller coaster of late. Now, all said and done, we're still in this messy range, and I think it's going to need something big to break it. Firstly, the range was mainly 146.80s up to 148.80s, but it looks like we might now see the bottom of that range extended out, maybe down to 146.25.30, as that was the area around there that saw the bulk of the action over the Fed. That's the area we were trading around before, then we had the spike, but we got quickly back above it. Now we're past the Fed and the Bank of Japan. Attention is going to switch to the Japanese leadership elections at the beginning of October. And so we're likely to see more input from the yen side, both here and in the crosses, and more so than before. Now, my bias pre-Fed was to be bearish on this pair. And my bias now is a bit more bullish. And that's on the pair in general, not just the yen. So I was bearish on the dollar going into the Fed, and now I'm a bit more bullish on the dollar and a bit more bearish on the yen. Now, I'd have that stance irrespective of the fact I'm actually long this pair at the moment. So the yen moves will come as we start to get the polls of the leadership contest and who's leading and who's moving here and who's moving there. And also the policies that we get from the various members. Are they going to be hawkish? Are they going to be dovish in terms of fiscal spending and the like? Now, just in case you didn't know, there's one runner in this race, Takeichi, and the market is seeing her as potentially the most dovish for the yen. But the market knows this. She's gone into the hat. She's officially said she's running. So the market knows that this is a dovish risk. It's already had a little bit of a reprice on that. So we might find that we actually see maybe some bigger moves coming on any of the other runners, anyone else who enters the competition or the contest. As I said, moving forward, expect a lot of blathering over policies from all these new runners, trying to woo voters and how they're going to do this for the economy and that for the economy and so on and so forth. And that's going to be the stuff we're going to trade. And it's all probably going to happen during the Asia session. Now, all that remains for me now is to have a look at what's coming up next week and how I'm going to look to trade it. But before that, I'm going to point you in the direction of our trader funding program, where you can scale up your trading by trading our money. And to give you a bit more insight in that, I'm going to hand it back to Blake. So over to you, Blake.
Are you looking to get funded as a trader? Why would you want to get funded? Well, the markets are extremely volatile. There's a lot of great opportunities, but because of the volatility, you don't want to risk your own money. You'd rather risk somebody else's money. That's why traders get funded. At Trader Funding Program, we have two different options that you can choose from. One, instant funding. That means immediately you can access up to $100,000 in capital. Now, by doing that, you have risk parameters you have to follow. You can't lose more than 8% on a trailing basis. That means as you're making money, you can't lose more than 8%. You also can't lose more than 5% intraday because we want to make sure you can control your risk. That is your instant funding program option for you. But let's say you wanted to take a more economical approach. You can access up to $1 million with the one-step assessment. Now, the one-step assessment, that means that you can't risk more than 6% of your high water mark to pass your assessment. That means as you're trading a demo account, as you make money, you can't lose more than 6% with an unlimited amount of time. Once again, you can't lose more than 5% intraday because we want to make sure you can control your own risk. Now, with either option, you have the ability to keep up to 90% of the capital that you make, 90% of your returns. That's pretty awesome. You know what else is great? With either one of those options, you get included in the Forex Analytix community for a certain period of time. The Forex Analytix system does analysis on 30 different instruments, everything from currencies to gold to indices, and it gives you different trade ideas, analysis, live squawk feed, so you're up to date on news, you have risk management tools, everything that you would need as a trader in your toolbox to help you become successful. But more than that is you're included in the Forex Analytix community, the private chat rooms where you have access to me and other analysts from Forex Analytix. Imagine being able to see what I'm trading, to be able to talk to me and other analysts and other traders and see what they're doing and ask questions. Why trade alone when you don't have to? You should utilize a company like Trader Funding Program for your funding needs. So check out Trader Funding Program for more information. I'll see you soon.
Right, I'm back again, and I will add to what Blake said. Keep an eye on our Trader Funding Program site over the next few days, as I think there's going to be some special offers dropping soon. So that's a little bit of a heads up. And also, don't forget to sign up for our newsletter, where you can find out about our change to Trading Analytics and some of the goodies that are coming when we launch. If you want to sign up for that, if you haven't already, go to ForexAnalytix.com, our main page here. You can click on something big is coming, click that link and sign up to the newsletter there, or click the newsletter button up there, and that will take you to the sign up page, and you can find out all the goodies that are coming later in the year. Right, so let's move on to what's coming up this week. As I mentioned, we're probably going to have a bit of a quieter week, but we still do have some important events to come. Firstly, we get the PMIs kicking off on Tuesday, and this is the first real data to put the latest central bank messages to the test. Will we see Eurozone countries finally getting manufacturing back into expansion? As they've been creeping that way recently? Will France stop looking as crap as it has been? Who knows? But this is the data, the first sort of real important data, up-to-date data that we're going to get post all these central banks. Then on Wednesday, we get new home sales from the US. We saw a little bit of a wobble in starts and permits last week. So give a look at the housing market just to see if there's going to be any trends developing. It's something I look at quite a lot. We're not seeing anything that I would wave any yellow flags over or be worried about. But trends always start somewhere. Then we move into Thursday and we get the final US Q2 GDP data. Now, we're just about to close off Q3, so this data is old hat. But even so, the market may move if there's a big variation in the final number. Now, in theory, they shouldn't be, but you never know with data. So just keep half an eye on that GDP data. Now, Friday is more interesting as we get the first inflation numbers out of Japan for September. That comes via the Tokyo inflation report. Now, this data is important because it drops before the main country CPI, the main national CPI number. So if this is a hot one, that's going to be another feather in the cap or the BOJ's cap for a hike. So this data could be super important as to whether we're going to get a hike sooner or rather later from the Bank of Japan. Then finishing off on Friday, we get US F.A.C.E, which has pretty much lost all its surprise these days after Powell once again at the FOMC tipped the numbers at that meeting. We are expecting F.A.C.E to go up a point to 2.7% from 2.6%, and that's year on year, and the core to stay unchanged at 2.9%. Now, if there's a big miss either way, we're going to get that first rejigging of rate expectations since the FOMC. So this might be the data that really gives us a look at how the market is going to trade changing data if there's a big variation. So keep your eye on that. We know what the Fed's expecting to do the rest of the year next year. Will this data change that view in the market's mind? It's going to be pretty important, even if Powell has given the game away. Now, that's pretty much on it on the data front. So now I'm going to have a look at what I'm looking to trade next week. Now, just before we go on, one thing that I have missed out on or left out in talking about the data is that we've got the SMB meeting coming up, and that happens on Thursday. They only have quarterly meetings. This is their Q3 meeting. Now, there's no expectation for any rate move, as rates are already at zero, but all the talk will be about whether they're going to go negative. Now, S&P Governor Schlegel has constantly been telling us that negative rates is a tool that is available, but one they don't envision using yet. Now, the importance of this meeting will be if they are any closer to doing so. Now, with inflation barely above zero, the market is going to be pushing their buttons over going negative on rates, be it now, be it later, be it whenever. So the Swiss franc is going to be an important currency this week. So looking at dollar Swiss first, now while we had a bit of a break below the prior low, as you can see there, that 78.71 low, that happened over the Fed, and we did reclaim that level pretty quickly after, and once again found support, as you can just about see in there, right after. Now, at any other time, I'd be calling that move, that break of the prior low, as bearish. But as it was made over that Fed meeting, right in amongst a lot of volatility, I'm less inclined to trust that move. The nature of it, just, any other time, yeah, I think that's bearish. We've broken the prior low. The trend that we've seen all year is bearish. That's got every chance of continuing now on its way down. But because it happened over that Fed event, I am less inclined to trust that move, that break, and the fact that we got quickly back above it. Now, that doesn't mean we still can't go down, but it's going to need something else to do it. And if there's a surprise at this meeting and maybe they do go negative or indicate they're ready to pull the trigger in December, then that may be the time that we do see a proper break. But again, you have to be very careful with this one. If you think shutting your eyes and selling Swiss is going to be the play, that's where you've got to be careful, because it might be a bit more dangerous than that. They will know, the S&B will know how such news will be big for the market, and they will therefore be ready to intervene to stop any excessive moves. Now, the S&B doesn't just come piling in with intervention and buying Swiss pairs and pushing them up, or selling them and pushing them down. They're not movers of the market. What they will do is just, in this case, they'll just go and sit on the bid. They'll just phone their banks or speak to whoever and just lay it in bids. So they'll sit there just buying, not pushing it up. They won't chase the market up. They'll just sit there soaking up whatever the market's selling to them, and they'll soak up that excessive selling. Now, when we're in the chat room, we call it smoothing. They're not looking to push the price any particular way. They just want to soak up what's being thrown at it. So for this pair and other Swiss pairs, be on guard if there's big news, because it doesn't mean that the currency is going to move meaningfully in that way. You may get a sharp move, but if it's looking very big, you just got to be careful what the S&B do with that. So regarding dollar Swiss, I think, from here, yes, we need to focus on this low again, 78, 75s. We've also got a prior level down here at 78, 79, which is a bit more historical. It goes way back to, let's look at it quickly, just so you know what I'm talking about, if I can get it on the right chart. So that just goes all the way back to this area here when we had the big old blowout. Okay, the reason I've got it in there is because we still don't know what the actual low is in all this time here. So this was a pretty big move. So I just take it from where we get a lot of price action, close together. So those are the key levels for this one. What can we do from here? Well, if we are going to see a bounce again, maybe if we see the dollar continuing to bounce, this one could push up, certainly back into the 80 figure. I'll be looking at probably stretch points for this one, maybe up towards the high 80s, 81s, 81.20, definitely up towards this 81.90, 82 area. If we're getting up there and there's no real game-changing news, then I think that's probably going to be a decent stretch point. Maybe look to see if we stay inside this range. Now, I want to take a quick look at Euro Swiss as well, because that's obviously going to be just as important this week over the S&B. Let's stick it on that one. So this one, I'm looking again more at the range for this one, which is, at the lower end down to sort of 92, 85, 90, and on the top side, 94, 35, 40. It's been a pretty tight range for pretty much since April, May. So it's very solid. It shows that the market doesn't want to push this anywhere in particular. If anything, I'm not going to do anything in the middle here or look to do anything in the middle here. I'll look to see if this S&B meeting maybe sees us pushing to one edge of the range or the other, and then I'll look at that for a trade, because when you're trading ranges like this, it's pretty low risk. You can scale in towards a low down here. You don't need to have a big wide stop, maybe below that extension and prior level down here. You're talking 30, 40 pips. It's not a huge amount. But if you manage to stay in the range, then you could get a bit of a reversal back up towards the top. So that's what I'm looking at for this one. Now, the next one I'm going to look at is Euro Sterling. This is something that I've been looking at for quite some time now, and mainly looking at pound shorts. I'm already long this pair, so I'm short the quid via this pair, all the way down from, I'm long from 87s all the way down to 86s, and I've been jobbing it around between those two levels. Now, I think we're going to be getting into the zone where what's going on in the UK is going to start to matter. And when I say that, if this goes to plan, I'm thinking that the UK is going to see some weakness going into the latter part of the year. Not only that, we've got the budget to come from Reeves. There's a lot of pressure on her to deliver. I can't see any ways where she's going to come out of this covered in glory. So if this does go to plan and the UK economy suffers, and by that I mainly mean, we see further weakness in the jobs market and maybe inflation starts coming back down significantly again. And those are the minimum negatives that I'm looking for. And indeed, Rachel Reeves makes an absolute mess of the budget. We could be seeing massive upside in this pair. Now, irrespective of your views on the UK, on Europe, or whether you're interested in the fundamentals or not, we are at a very big level here, 87.20. Now, this level has often been the gateway to some very, very big moves, and it has the potential to do so again. Now, we've been up here before, this 87.20 level, many times over the last 2 years, and we haven't been significantly over it since 2023, this period here where we'd had all this mess from running up to the 90s. And look what happened when we broke below. We came below, we then found, we had a little break back up, but we found resistance below the level, below the level, below the level. We couldn't sustain the move above it, resistance after, and then we got the big old move down to 82s. And then even then, on the way back up, we've tried it and tried it and tried it, and we can't get a hold above it. So that shows you how significant this level is. Just one number. Now, as usual, nothing is guaranteed in trading, and what happened before is not a promise of that happening again. But if we do get back above this 87.20 and hold it, there's the potential, and it's a low risk potential trade, that could turn into an absolute flyer. Now, as always with this pair, though, one needs a lot of patience, as it can stagnate in small ranges for days and weeks, just like we've been pinging between 86 and 87 for a while. So this is not a pair for the excitable trader. As I'm already long, as I said, between 86 and 87, I'll be watching for a break and hold of that 87.20 area to potentially add to my position and see what it does next. And that's something traders can look at. You don't have to wait for a dip. This 87.20 level is significant enough on its own that you can trade against it either side. Now, last thing I want to look at is US 10s, and I'm going to give you my boring old warning. We've obviously had this big move after the Fed. We know the news. We know what they're up to. This is going to be your key guide to watch for how the dollar may move after. And I'm not talking about which direction it may go necessarily. I'm talking about how far the dollar might move on any particular event, be it a data point, be it the next Fed meeting, whatever. The levels in yields have been very, very clear. They've been very, very clear for months. We've had this 4% level. That's been solid over the last couple of days and over the Fed. We've had this 420 level, which was part of the 420, 450 range that we walked in between for quite some time. Yes, we had the odd move below. Yes, we had the odd move above. But again, we couldn't stay above those levels. And what I said over the FOMC was that all traders should have had this chart open, because as much as we got that dollar sell-off, that move could not break 4% in yields. Okay, yes, we got a significant sell-off in the dollar, but these 10-year yields could not bust that 4% mark. They marginally got below it, and then they quickly reversed. And what do we see? The dollar following. So you use this for a gauge. Okay, if we get a 200,000 plus NFP report next time, we may see yields running up to 420. They may go through 420. But if they don't stay above 420 and quickly get back below, any dollar rally that you've been watching over those NFPs is going to pause, or it's potentially just going to pull back. Doesn't mean that this is a reversal indicator. It just means if the dollar's going to move, yields will be holding the leash. Okay, that's how I look at these 10 years. So I know it's a bit boring that I keep repeating this, but it is so important for traders, if you're trading the dollar, to know your expectations of what a move may do. And that brings me to the end of this week's video. But before I close up, I just want to make you aware that this is the final week or the weekend of our summer sale, where you can join Forex Analytix for 40% off a monthly subscription. So if you do want to grab that deal, this is the last few hours you can do that. It'll be gone by Monday. And with that, I hope you enjoy the rest of your weekend, and I'll see you in the chat room and on the shows on Monday. Have a good one.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.